LPA Waterfalls explained in plain English, LP-friendly drafting. Welcome. In private funds, the LPA Limited Partnership Agreement is the rulebook. It sets out rights, obligations, fees, and, most importantly, how money moves. The waterfall is the step-by-step order of cash distributions from the fund to investors and the manager. It answers who gets paid, when, and how much. A tight waterfall protects LPs from surprises and gives GPs clear guardrails. Clear wording avoids disputes, smooths audits, and saves legal costs later. By the end, you'll know the key terms, how each distribution bucket works, and what to watch for when reviewing or drafting an LPA. Meet the cast. LPs are the investors providing capital. The GP manages the fund. The fund pools money to make investments. Distributions flow through buckets: return of capital, preferred return, pref, catch-up, then carry. Each bucket has conditions before the next one activates. Example: LPs first get back their contributed capital. Only after that, and the pref, does the GP earn carry. Precision matters. Define participants, the fund, and each bucket consistently across sections, so math and the waterfall, definitions, and fee clauses all match without hidden conflicts. Start with contributed capital, the actual cash LPs paid into the fund, net of any returned amounts. Distributable proceeds, cash legally available to pay out after closing costs, reserves, and required withholdings. Spell out expenses and fees that come off the top, transaction costs, broken deal expenses, management fees, so no one double deducts. Separate realized from unrealized. Distributions typically come from realized proceeds, exits, interest, dividends, not from paper gains. Example: a markup on a portfolio company does not fund carry. Only a sale closing with cash does. The preferred return is LP's minimum annual return, often 8%. Decide if it's non-compounding, simple interest, or compounding, interest on interest. It accrues from each contribution date until paid. Be explicit on day count: actual/365, actual/360, or monthly conventions. Clarify pause rules. Does the pref stop during suspension periods or force majeure? Key guardrail: no carry is paid to the GP until both capital and accrued pref are fully satisfied for the relevant LPs or the fund overall, as defined. Waterfalls usually prioritize return of capital to LPs before any profits to the GP. Specify the order. Do unpaid fees and expenses come out before capital? How are recallable amounts treated? Can returned capital be called again for new deals? Define recycling rules, when and how proceeds may be redeployed, and any caps or deadlines. State whether management fees reduce capital returned. Some models net them against contributed capital, others do not. A clear ordering avoids accidental over or under returns that can distort later carry. After capital and pref, many funds run a catch-up. The GP temporarily receives most, often 100%, of distributions until the agreed profit split, say 80/20ths, is achieved overall. Then ongoing carry applies. Profits are split by that ratio going forward. Use crystal clear examples. Show $100 of profits after pref and capital. Illustrate how much goes to the catch-up, when it ends, and the final split. Golden rule: carry applies only to profits after the pref and return of capital are satisfied, per the definitions and timing in the LPA. At fund end, run a clawback. If the GP received excess carry versus the final results, the GP must return the excess. Define whether the amount is calculated net of taxes, the repayment deadline, and acceptable security, personal guarantees, escrow, or LP giveback. Many LPAs include an escrow/holdback on carry distributions to pre-fund potential clawback. LP-friendly terms add interim clawback checks, for example, at year 5 and 8, to reduce end-of-fund surprises and protect LPs if late losses reverse earlier gains. Write for humans. Define every term once and use the same words everywhere. Build the waterfall as numbered steps so cash flow is easy to follow. Include sample calculations and timelines, contribution dates, pref accrual, return of capital, catch-up, and carry examples. Kill ambiguity. Specify dates, rates, compounding or not, day count, and exactly which fees are deducted where. Add worked examples for realized versus unrealized gains. Clarity now prevents disputes later and makes reporting simpler for both LPs and the GP.